Namaskar. Let us start the session 35. Here we will discuss something different for you. There is no what is called topic for you here to discuss. We have to go for a test. The test is designed. What are the session we have covered over the 35 sessions. The test is designed in such a way that to test your objective evaluation and also your subjective understanding of different segments of the international financial system. So, I have designed a test for you. The test consists of two parts. Parts one is your section A, that is multiple choice question. I will be asking you 20 questions here. Section B is short questions, that is 5 questions will be there. You have to answer within 100 words. So, total test duration is 1 hour and here 50 marks I have given to you. The 50 marks spread over to 20 marks for 20 some objective questions and 6 marks each for 5 subjective questions. So, let us start with the test. I will first discuss about the multiple choice question 20 questions. After that, end of the 20 question I will show you the key to the answer. Then we will go back to the subjective questions, and subjective questions I will give you only the clue to the answer. So, on what basis you can write the answer, that much only, it is up to you to write the answer. So, let us start with the multiple choice. Here multiple choice question number 1 is interest rate parity refers to the concept A, the same good must sell for the same price across country. B, interest rate across country will eventually be the same. C, there is an offsetting relationship between interest rate differential and differential in the forward spot exchange rate. D, none of the above. You indicate the answer and keep it to you. Question 2. According to the purchasing power parity theory, the value of a currency should remain constant in terms of what it can buy in different countries of A, bonds, B, stocks, C, goods, D, land. You tick the answer and keep it with you. Number 3, a forward rate is equal to future spot rate if foreign exchange markets are A, controlled by the government, B, efficient, C, controlled by speculators, D, are partially controlled by International Monetary Fund, E, none of the above. You mark the answer and keep it with you. Number 4, the Fisher effect assume that the real interest, number A, the real interest rate is equal to the nominal interest rate. B, nominal interest rate is equal to the real interest rate plus the inflation rate. C, inflation rate is equal to the real interest rate. D. Nominal interest rate is equal to the inflation rate. E. Nominal interest rate is equal to the inflation rate. Mark the answer, keep it with you. Number 5. The international fishery effect says that A. Exchange rate differential reflects the inflation rate differential between two countries. B. Expected spot rate reflects the interest rate difference between two countries in the opposite direction. C. Future spot rate reflects the forward rate. D. Interest rate is greater than the inflation rate. E. All the above. Mark the answer, keep it with you. Question number 6. Economic exposure have effect on the A. Future sales volume, prices and cost of companies. B. Present earning of the company. C. No effect on company's balance sheet. D. Limited effect on present profit of company. Mark the answer, keep it with you. Number 7. Number 7, according to finance theories, translation exposure A. Only notional accounting losses and gains. B. Directly affect the present cash flow. C. Affect the future cash flow. D. Both B and C. Mark the answer, keep it with you. Number 8. If transaction exposure are different dates, then it can be hedged A. by purchasing single forward contract, B. by purchasing multiple forward contract, C. cannot be hedged by forward contract, D. none of the above. Mark the answer, keep it with you. Number 9. Traders who traded among themselves in foreign currency future contract are called A. floor traders, B. floor brokers, C. buyers of future contract, D. seller of future contract. Mark the answer, keep it with you. Number 10. Number 10, interest rate swap involve counterparty who wants to A. Exchange a floating rate commitment for a fixed rate loan, B. Exchange debt for stock, C. Exchange a short term loan for a long term loan, D. A and B. Mark the answer, keep it with you. Number 11, a representative collection of goods cost 9,625 rupees in India and US dollar 174 in USA. What would be the exchange rate between US dollar and Indian rupee? A. Not possible to find, B. 53.3161 per dollar, C. Data insufficient, D. rupees 53.03 per dollar. Mark the answer, keep it with you. Number 12, the annual inflation rate is expected to be 8% in India and that for the US is 3%. The current exchange rate is 46.5500 per dollar. What would be the expected spot exchange rate in 6 months for Indian rupee relative to US dollar? A. rupees 46.6665, B. rupees 45.4597, C. rupees 48.8097, D. rupees 51.1791. Mark the answer, keep it with you. You can use the calculator also. Number 13. Number 13, as per monetary approach, if the target inflation rate is 6% and growth in money circulation is 1%, what would be the rate of growth in money supply in the economy so as to achieve a real GDP growth of 8%? A. 14%, B 15%, C 13%, D 9%. Mark the answer, keep it with you. Question number 14 and 15. I am reading the question to you. Here I have given a small paragraph of write up. After that, question number 14 and 15 will come. The write up is here. ICICI Bank's ADR is listed in New York Stock Exchange with a share ratio of 1:2. As on February 12, 2013, at National Stock Exchange of India, its ICICI Bank share price was hovering around rupees 1140.95, while at New York Stock Exchange ICICI Bank ADR was hovering around $43.71. ADR and domestic equity transaction cost is $0.25. Is there any arbitrage opportunity between ADR and domestic equity of ICICI Bank if US dollar is rupees 53.82. With this background, the question number 14 is, what is the estimated price arbitrage between ADR and domestic equity? Answer to question number 14 is, what is the estimated price arbitrage between ADR and domestic equity? Answer to question 14 is A rupees 69.71, answer B rupees 70.5722, C rupees 10.11, D rupees 53.82. Mark the answer, keep it with you. As per the earlier write up, the question number 15 is, what is the estimated arbitrage profit between ADR and domestic equity? Answer to question number 15, A rupees 10.11, B rupees 69.57, C rupees 57.1122, D 0. Mark the answer, keep it with you. Question number 16. question number 16 to 18, that is 16, 17 and 18, there is a write up. On that basis, you have to answer question number 16, 17 and 18. The write up is here. The official British price of gold was 6 pounds sterling per ounce, and that of the US price of gold is $12 per ounce. The shipping cost of gold from US to Britain is 5 cents. With this background, you have to answer question number 16, 17 and 18. Question number 16 is, what would be the mint prices of gold in the respective countries? Answer to question number 16 is A, $2.05 per pound sterling, B, $2 per pound sterling, C, $1 per 2 pound sterling, D, $1 per $2.05 pound sterling. Question number 17, as per the above write up. Question number 17 is, what would be the gold transport rate for US importer? Question number 17 is, what would be the gold transport rate for US importer? Answer to question number 17 are A, exchange rate beyond $2.05 per pound sterling, B, exchange rate beyond $1 per 2.05 pound sterling, C, exchange rate beyond $1 per 2 pound sterling, D, exchange rate beyond $1 per 2.10 pound sterling. Mark the answer, keep it with you. Question number 18, as per the above write up. Question number 18 is, what would be the maximum exchange rate for US importer? A, $2.05 per pound sterling, B, $2 per pound sterling, C, $1 per 2 pound sterling, D, $1 per 2.05 pound sterling. Mark the answer, keep it with you. Question number 19. Question number 19 is, in the interbank market, rupee is quoted for November 2012 as spot rate 1 US dollar is rupees 53.2550 to 53.2600. The interest rate in USA is 4% and that of in India it is 8%. What would be the 1 year forward rate so as to remove any arbitrage opportunity? Answer to the questions are A rupees 55.3852, B 55.4150, C 53.3033, D 57.5208. Mark the answer, keep it with you. Question number 20. A currency is said to be a premium currency if A forward price is higher than the spot price, B forward price is lower than the spot price, C if the currency is depreciating its value, D if the domestic interest rate is increasing. Mark the answer, keep it with you. Your 20 questions are over. Let us see what you have done and let us discuss about all questions. Let us move to the question number 1, answer is C. The question is here, interest rate parity refers to the concept that, your answer is C. Interest rate parity means there is a offsetting relationship between interest rate differential and differential forward spot and forward exchange market. Interest rate parity, that is difference between the two country interest rate, should be equal to the spot minus forward rate. Thus, forward, this is the interest rate parity hypothesis what we discussed earlier session. So, interest rate parity hypothesis equalize the interest rate differential with the forward premium. So, the answer will be C. Then question number 2, answer also C. What is the question number 2? According to purchasing power parity theory, the value of a currency should remain constant in terms of what it can buy in different countries. Your answer is C, because purchasing power parity theory mentions that the goods prices of purchasing power, that is priced, that power to purchase goods should be same across the country. So, purchasing power try to equalize the prices of goods. Whenever there is a differential in price, the goods, the country having higher price of goods and services, the country exchange will depreciate, rate will be depreciating. So, here the question is C, in case of purchasing power parity theory, goods prices should equalize across country. Then number 3, answer is B. Number 3, answer is B. What is the question number 3? A forward rate is equal to a future spot rate if foreign exchange markets are here. The foreign exchange market should be efficient. The foreign exchange market is efficient whenever there is no tax, there is no barrier of flow of funds, no taxation, no such kind of what is called transaction cost. The market is efficient, then forward rate equal to the future spot rate. The forward rate equal to future spot rate if market is efficient, that is question number 3, answer is B. In case of question 4, the question 4, your question 4 is the Fisher effect assumed that Fisher effect, that Fisher international Fisher effect we discussed earlier classes, earlier session. Here question number 4 is answer is B. Question number 4 answer is B. So, here future Fisher's effect assume that nominal interest rate equal to the real interest rate plus inflation rate. So, nominal interest rate is nothing but real interest rate plus inflation, that is Fisher effect mentioned. So, when the country having higher inflation, higher nominal interest rate and country exchange rate will depreciate. Indian interest rate is higher, Indian inflation is higher, Indian inflation nominal interest rate is higher, for that reason rupee is depreciating against dollar. So, number 4 Fisher effect assume that the answer is here B. Okay. Nominal interest rate is equal to real interest rate plus inflation. In case of question number 5, the answer is B. Question number 5 answer is B. What is question number 5? Question number 5 answer is B. What is the question number 5? Question number 5 I mentioned that international Fisher effect. International Fisher effect nothing but the expected spot rate reflect the interest rate differential between two countries in opposite direction. So, when the expected spot rate reflect the interest rate differential between two countries in opposite direction. So, interest rate is the country having higher interest rate, its spot rate will depreciate. So, here question international Fisher effect, the answer is B. In question number 6, the answer is A. Question number 6 answer is A. What is question number 6? Question number economic exposure have the effect on future sales volume and cost of company. So, here the economic exposure have the effect on the future sales volume, the future sales, future prices, future valuation of the company is affect because of the economic exposure. Number 6 question answer is A. The question number 7 answer is A. Question number 7 answer is A. What is question number 7? Question number 7, according to finance theory, translation exposure. Translation exposure is the accounting exposure. So, here there is no, it does not affect the asset liability of the company, it does not affect the value of the company, it is adjustment in the process of accounting norms. So, here the question number 7 answer is A, only notional accounting losses and gains, only notional accounting losses and gain. The question number 8 answer is B. Question number 8 answer is B. What is question number 8? If transaction exposures are in different dates, then it can be hedged by purchasing multiple forward contract, because in transaction exposure is a exposure because when exchange rate fluctuate, it affects the assets and liability of the company, the income source of the company. So, since the exposures are different rate, you have to different date. So, you have to purchasing of multiple forward contract. You have to purchase multiple forward contract for each date, each exposure date. You have to purchase one forward contract. So, multiple forward contract you have to purchase for measuring, for absorbing transaction exposure which are having different date. So, question number 9. Question number 9 answer is A. Question number 9 answer is A. What is question number 9? Traders who traded among themselves in foreign currency future market, they are called the traders who trade foreign currency futures market, they are called question number, there is question number 9. Question number 9 answer is A. They are called floor broker, floor trader. those who trade among themselves in foreign exchange future market, they are called floor trader. The question number 9, answer is A. The question number 10 and also answer is A. Question number 10, answer is A. So, what is question number 10? Interest rate swaps involve counterparty who want to exchange a floating rate commitment for a fixed rate loans. So, in case of interest rate swap, we generally, as we discussed earlier session, interest rate swap is for converting differential, that is floating rate interest debt to a fixed rate debt or a fixed rate debt to a floating rate debt. So, here exchange a floating rate commitment to a fixed rate loan is nothing but interest rate swaps. Similarly, question number 11, the answer is B. Question number 11, the answer is B. What is question number 11? A representative collection of goods cost 9,625 rupees in India and 174 rupees in US. What is the exchange rate between US dollar Indian rupees? So, here US dollar, if you see the calculation as I mentioned, US dollar 174 is equal to rupees 9,625. So, US dollar 1 will be, you have to divide this 9625 by 174, you will get the actual rate. Here answer is B. Answer is B, that is rupee 55.6161. So, question number 11, the answer is B. How to calculate? $174 is equal to 9,625 rupees. So, what will be the $1 rate? That will decide the exchange rate between Indian rupee and US dollar. In case of question number 12, the answer is C. Question number 12, answer is C. What is the question number 12? Annual inflation rate is expected to be 8% in India and that of the US it is 3%. Current exchange rate is between US dollar Indian rupee is 46.5500. So, what would be the expected spot rate after 6 months? Here you have to include, how to calculate, here you have to discuss what we have discussed earlier classes, international Fisher's effect. The interest rate differential reflect the future spot. So, you have to what is the interest rate differential between Indian rupee and India and US? India is 8%, US is 3%, interest rate differential is 3%. In 6 months, the rupee will depreciate by 3%. So, what will be the annual depreciation? You have to calculate annual depreciation, make it to 6 half yearly depreciation and that depreciation you have to add in 46.5500, that will be the new rupee rate. So, new rupee rate will be to answer will be 12 number answer is, as I mentioned 12 is C. So, here to see 12 answer is C is 48.8070. So, here calculation is interest rate differential Indian interest rate minus US interest rate is reflect the depreciation of or appreciation of rupee. So, current spot is 46.5500. The interest rate differential 8% minus 3% is 5%. Rupee will depreciate, annual depreciation will be from here, it will depreciate by 5% and what will be the 6 month depreciation you have to calculate and add to this. This will be your answer. Your answer is 48.8097. Answer is C. Let us move to question number 13. Question number 13, the answer is C. Question number 13, answer is C. What is the question number 13? Question number 13 is, as per monetary approach, if the interest rate if the target inflation is 6%, growth in money circulation is 1%, what will be the growth rate in money supply to achieve a growth rate of 8%. So, here we want to have a growth rate, annual growth rate of 8% with 6% inflation, 8 plus 6, 16, 14%. So, 14%, and what will be the money circulation? 1%. So, 14% minus 1% is 13%, that will be answer. So, answer is 13%, answer is 13. So, inflation is nothing but, so inflation plus the real growth rate minus the money circulation, money velocity of money circulation, that will be the answer to the money supply. Here 8 plus 6 is 14, minus 1% circulation of money, velocity of money, that will be 1%. So, 13% is the money supply growth rate in the economy. So, question number 13, answer is C. In question number 14 and 15, you have to answer with the exam write up. So, here, so NSC ADR price is ADR. So, 1 ADR 1:2, that is 2 domestic share equivalent to 1 ADR. So, ICICI Bank share price in NSE at present 1140.95. So, 1140.95 rupees, and in NYSE ADR price is equal to US dollar 43.71. So, 43.71. So, but 2 equity price equivalent to 1 ADR price. So, 2 equity price will be 1140.95 into 2 supposed to be equal to US dollar 43.75 into current rate of exchange rate. Current exchange rate is $1 is 53.82, 53.82. This will be equivalent. If it is not equivalent, there is arbitrage opportunity. So, what is the price arbitrage? You can calculate from here. The price arbitrage is here. Price arbitrage, the differential of these two is the price arbitrage, and this price arbitrage is how much? If you see, the answer is 70.5, 14 answer is B, 70.5722, 70.5722. What is arbitrage profit? Arbitrage profit, price arbitrage minus the transaction cost. Transaction cost is how much? Transaction cost is US dollar 0.25 into 53.82. This is a rupee equivalent of transaction cost. So, from 70.5 to 5722 minus this equal to what is called the 15 number answer. What is the price arbitrage? Price arbitrage is something around 57.122, 57.122. This is the answer to 15 number question. 14 number question answer is A, 15 number B, and 15 number question answer is C. This is the calculation process as I mentioned here. So, the 1140.95 into 2 equal to US dollar 43.71 into this, and this will be the arbitrage profit. And what is the price arbitrage? And arbitrage profit is price arbitrage minus transaction cost is the arbitrage profit. So, that is the answer to you. Now, let us move to question number 16 and 17 and 18. Question number 16 is, if you read the question number 16, we have given a write up to you. The write up is your gold price in per ounce of gold price in US, in Britain is 6 per ounce, and in US dollar it is 12 per ounce. So, and gold transport cost, shipping cost, transport cost or shipping cost, transport cost is 5 cent. So, then question number 16, with this question number 16, what would be the mean price of gold in respective country? Mean price of gold is nothing but that, means nothing about the US dollar 12 by 6 is equal to 6 pound sterling is equal to 1 pound sterling price, 1 pound sterling price. So, this is $2 US dollar is equal to 1 pound sterling, 1 pound sterling, 2 US dollar is equal to 1 pound sterling, that is mean price of the gold. So, here question answer is B, 2 US dollar is 1 pound sterling. The exchange of gold price these two countries, the mean price of gold. So, what we discussed earlier session, 2 per dollar per 1 pound sterling. What will be the gold transport? So, question number 16 answer is B. Question number 17, what will be the gold transport rate for US importer? So, when the gold price increase beyond this, beyond 2.05, beyond 2 point, because the transportation cost is 5 cent. So, when the gold increase beyond 2.05, it is better to transport the gold rather than paying this. So, it is because it will be less costly. So, here the gold transport point for the US importer is 1 pound, that is $2.05 per pound sterling. The answer is A. The answer is A, $2.05 per pound sterling. So, now question number 18, what would be the maximum exchange rate for US importer? So, a maximum exchange rate US importer, how much they have to pay maximum? So, this is nothing but same gold transport point. So, here answer is 2.05 per pound sterling, $2.05 per pound sterling. If the importer the exchange rate is beyond this, the importer will transport the gold rather than pay it. So, the question number 18, the gold transport maximum exchange rate for the US importer is question 18 number question, answer is A, 2.05 per pound sterling. Now, question number 19, question number 19 is the question number 19, here in the interbank market rupee is quoted, spot rate is 53.2550 and 53.26. So, interest rate between US dollar, US is 4% and India is 8%. What will be the 1 year forward rate to remove the arbitrage opportunity? So, suppose how to calculate? So, suppose you borrow $100 from the US. So, US $100 you borrow. So, you have to pay annually you are borrowing. So, you have to pay US interest rate is 4%, you have to pay interest cost will be US dollar 4. So, annually you are paying $104. When you bring $100, so to India, you have to convert into Indian rupee, the sale dollar, the selling rate of dollar is you will get 53.2550, 53.2550 and this is the rupee you will get, this much of rupee you will get, and this rupee, if this rupee you will invest in India, so you will get an interest of 8%. So, 100 into 53.2550 into 1.08, this much annually for you, this is, but annually in US dollar is this much, annually in rupee is this much. So, this is supposed to be equal if there is no arbitrage. So, what will be the no arbitrage point? No arbitrage point is dollar equivalent. No arbitrage point will be dollar equivalent of 104 equal to rupee equivalent of 100 into 53.2550 into 1.08. This is, you can calculate what is the rate. So, here to remove arbitrage, this will be the rate. So, this rate is nothing but, if you calculate, the rate will be answer to 19 is C, the rate will be 53.3033 per dollar. US dollar will be 1 US dollar will be this much. To calculate, because $104 you are paying after 1 year, and after 1 year rupee equivalent is this much, and if there is no arbitrage, there is no interest rate again. So, this point will be 53.0333. Now, question number 20. So, here answer is C. Okay, 19th question. Question number 20, a currency is said to be premium currency. Premium currency value is increased. So, forward price will be more than the spot price. So, answer is here question number 20, answer is A. So, question number 20 answer is a forward price is higher than the spot price, then the currency is said to be a premium currency. So, okay, rupee depreciating, forward price is lower than the spot price. So, it is depreciating. So, depreciating currency. Premium currency is a currency whose value is increasing. So, forward price is higher than the spot price. This is the answer to all 20 questions. Let us move to the short question. Short question, I have asked you here 5 questions, you have to answer in 100 words, and the answer for this I will give you only clue rather than writing of the answer. So, here first question is, why corporate India required hedging their balance sheet position? Why corporate India required to hedge their balance sheet position? Your answer to this clue, the answer is, the question is, why corporate India, why corporate sector is hedging their position? Because corporate at present have a significant exposure to international currency. They are either their revenue source, their export, their import, their payment of wage and salary, their payment of different kind of transaction fee are in different currency. Since currency are fluctuating, their revenue positions are fluctuating, their cost position is fluctuating, it creating a risk to the corporate world, and for that reason they need to hedge their position to immune from the risks of currency volatility. Second question, you have to write in different way with example. Second question, derivatives are not only means or instrument for hedging exposure. In this context, discuss alternative method of hedging. So, as I mentioned and as we discussed earlier, derivatives are instrument for financial hedging. Financial hedging is purchasing of currency swap, currency future, interest rate swap, interest rate future. These are the financial hedging, currency derivative of financial instruments of financial hedging. But these are only instrument. There is no other way to hedge. The other hedging instrument or hedging way is operational hedging. The operational hedging, negotiation, risk sharing, negotiation for contracts, changing of contract position. These are the other way of hedging. The operational hedging, you have to discuss how the buyers and seller can share the risks, how they design the contract, how they can go for redesigning the every 6 months they have to go for negotiation further. So, negotiation, risk sharing, contract designing, other way of operational hedging. What should be the hedging strategy for import intensive export oriented company? Third question, what should be the hedging strategy for an import intensive export oriented company? Here you have to understand that the company is exporting, any fluctuation of currency is a problem for them. The company is importing, any fluctuation of foreign currency also a problem for them. Here if the company has to see the currency of import and currency of export, both the currency are same, then netted balance they can do that. The both the currency are different, then different way of hedging they are supposed to do. So, they have to go for both the currency are same, then a payments are there which currency are fluctuating, and receivables are there where currency is fluctuating. Both the currency are same. So, that there will be positive effect for the company, they can go for netted balance approach. If the both the currency are different, then they go to for individual hedging for the actual balance sheet. Question number 4. Question number 4 is here, hedging has its own cost beside transaction cost. In this context, discuss optimal hedging. Optimal hedging is here, we have to discuss hedging has a transaction cost, hedging also need we are doing through derivative transaction. Derivative transaction has a what is called, in case of derivative transaction there are problems of not hedging of the financial institution, the company who has provide hedging, they may not adhere to the position. There is a position what is called what is called credit risks are there in case of currency hedging. So, optimal hedging is mix of what is called operational hedging and financial hedging. Question number 5, is there any difference in strategy of hedging manufacturing company, project oriented software company? Strategy of hedging for manufacturing company and that of project oriented software company. So, you have to distinguish the manufacturing company, project oriented software company first here. The manufacturing company generally have export import and they have a what is called different currency area of export, different currency area import. So, the export imports are different vendors will be there, but in case of software oriented project company, the maximum revenue comes from the export of the project. So, they generally face significant exposure in currency and their exports project oriented software company have a huge exposure, because one project might be having a huge amount of millions of dollars. So, exposure is significant, but in case of manufacturing company the export is not so significant, because the differentiations are there, because they may have export import not only one currency but many currencies are there. So, netted balance may provide them some kind of positive effect to them, but in case of export oriented software company, the netted balance is one currency exposure is significant. So, for them it is very difficult to hedge their position, they have to go for both operational and financial hedging, but in case of manufacturing company they can go for the financial hedging and prevent any kind of currency volatility in a significant way, but it is not possible in case of software oriented export oriented software company. They have to go for both financial hedging and also what is called operational hedging in the form of negotiation, in the form of contract designing, in the form of risk sharing, and to remove the volatility of currency exposure. With this, let me complete this session. You have to write all these 6 to 5 questions in 100 words each, so that it will be good for you to understand what we have discussed in earlier session. Thank you.